just an example, we're up 11 points. We were at 55 points. Then we turned to negative levels, and now we're up 11 points. All of this prompted a high-level meeting in Washington today with Congress, the Fed, and Treasury all weighing in. So now we come back to earth for a reality check with the individual investor. Our task force members today, Jacob Gold, president of Jacob Gold & Associates. He's in Phoenix, Arizona. And Vanita Phillips, vice president and trust officer at Canale Trust in Houston, Texas. And Andrew Ross Sorkin, reporter at the New York Times, joins me as well. Welcome to all of you.
Thank you. Great to be here.
Vanita, in looking at the notes that I have on what your clients are saying, something struck me as interesting, and we've been wondering whether the individual investor is worried about this. You say some of your very high net worth individuals are calling and asking about the safety of their money market accounts. Tell us about that.
Well, we've had a few calls about money markets, and I think that since we manage money intergenerationally for a lot of years for clients, they expect a 10% move in the market at any given time. What they don't expect, or what they want to know about, is what should they be worried about that they hadn't thought of before. And we hear some incidental reports of money market issues, possibly in Europe, and they just want to know, is this going to be a problem for my money market? Fortunately, we were out ahead of the curve and made the calls to find out if there were any problems that we should be aware of before we started getting the calls. Yeah,
they wanted to know what was in, whether they were exposed to commercial paper or the like in these particular instruments?
Absolutely. Asset-backed securities, lower quality, to increase that yield, to give them a yield enhancement. They just wanted to have an idea, is there something else they should be worried about?
Jacob, I wanted to talk to you a little bit about bonds, which have traditionally been thought of as a safe haven, if you will, but I understand you're moving some of your clients' money into cash. Why?
The reason for that is traditionally when we hear about corrections, everyone talks about wanting to buy when the markets are low and selling when markets are high, but most people do the exact opposite. With our stock holdings within our clients' portfolios, we feel that there is still some upside value there. So the last thing we want to do is to sell into this short-term correction. So we're taking some of our bond mutual funds, and it's important that people realize that it's bond mutual funds, not individual bonds. And we're just placing it in cash, putting it on the sidelines, so when we do see that the correction is short-lived and we see a more positive uptick, we have cash on hand to go back into the markets and buy at an opportunity.
When you say cash, though, Jacob, where, money markets, T-bills, what are you doing?
Yeah, both. We do money markets as well as T-bills. Obviously, with the most recent news of money market accounts out there and the risk that is possibly involved with them, we're very conservative, and we want to make sure that anything that's the most liquid. There are still money market / savings accounts out there that are FDIC insured, so that brings some more safety to us.
Vanita, you also bring up the fact that you think of some of what is going on here, and that your clients think some of what is going on here is related to the hedge fund redemption deadline.
Well, we have been watching that very carefully. Typically, hedge funds and some other types of investments, you're required to give 45 days, possibly even 60-day notice for a liquidation to occur. Some of those hedge funds will actually liquidate only at the end of the quarter. So we saw a real spike in volatility on 8/15, which was 45 days from the end of the quarter. We also looked at where money might have gone, and we saw a disparity in the yield that you could get on 9/30 on the Treasury bill that was maturing on 9/30 versus what you could get on 10/4. It was about 34 basis points, which indicated to us that there was some large money being parked on the sidelines in anticipation of that money being needed for some liquidity event on 9/30.
Very interesting.
Jacob, I wanted to go to you and really just start talking, if we could, for a second about 401ks. Everyone's got one, and everyone's trying to figure out, what should I be doing? Should I be recalibrating my portfolio? Should I be making changes right now and perhaps taking losses? What's your view?
That's a great question. A lot of our business is focused on the 401k market. We have the great opportunity of managing a lot of 401ks as well as deferred comp programs, one of which is for a local company, P.F. Chang's China Bistro. And something that's very important to understand is that investors inside 401ks are able to take on a little bit more risk and a little bit more volatility in the marketplace than, say, a retired individual. So with our corporate clients, we are encouraging them to stay well diversified, having money in both domestic stock as well as international and bonds, but just stay diversified and weigh out this marketplace.
You know, Jacob, it's interesting because you have both individual and corporate clients, which is something that we haven't really had a chance to talk about. Are the corporate clients that you're talking about, like a P.F. Chang's, worried about a downturn in the economy because of this event? I mean, they're very sensitive to that.
Everyone's sensitive to market corrections, but I think that within 401ks, we have a little bit more time to wait it out. Our retired clients, obviously, were a little bit more time sensitive and concerned about the short-term volatility. But 401ks as a whole and qualified plans, their time horizon is much longer than the average investor.
Benita, what are you hearing from your clients very quickly? Are they worried about an economic downturn or not?
We're coaching our clients that we are not expecting an economic downturn, and I think that for the most part, that's the way our clients are feeling. The only thing that's really looking like it could be a problem is housing. The rest of the numbers look good. We'll be watching the initial reports for unemployment on Thursday, but we feel very, very good that the economy is still healthy.
On that note, thank you both very much. Jacob,
thank you very
Benita,
much.
Nice to have you back with us again.
Appreciate it. Have a great one.
And Andrew, as always, and I'll see you a little bit later, too. We're coming up on the half hour, so we're going to update the markets for you. Bob O'Brien will have this hour's stocks to watch. And then it's time for the smart money. What are the good plays for you in the bond market right now? Some ideas on that coming up. Power Lunch continues in a minute.
You're watching Power Lunch on CNBC, first in business worldwide.